rolling here. I did want to, in full disclosure, I'd actually recorded one of these yesterday, but I did so without my microphone turned on, so there wasn't any sound. So I didn't send it out because I figured it would be extremely boring just watching me flash some charts on the screen. Before we get started, we'll get into some disclaimers here. Trading futures and options involves the risk of loss. Please consider carefully whether futures or options are appropriate to your financial situation. The material is provided as is and for informational purposes only. It is not intended to be a substitute for specific financial, trading, legal, or tax advice. Neither Farmers Business Network nor any of its affiliates make any representations or warranties, express or implied, as to the accuracy or completeness of the statements or any information contained in the material, and any liability therefore is expressly disclaimed. Past results are not necessarily indicative of future results. All right, let's get into what we are looking at today. So first of all, I'm looking at, I want to take a look at what harvest pressure looks like. Here's Canada's weekly canola farm deliveries. Now, there is a bit of a delay on this. This is into week 6, so into the middle of September. We aren't seeing major deliveries, or we are seeing an uptick in deliveries, but into the middle of September, not a flush that would suggest a major sell down like we saw, like we've been seeing in the last few weeks. I think there's a possibility that we will see, deliveries expand into week 8, 9, and 10. That's generally when they do anyway. We saw a really strong week last year that punched almost up to 700,000 tons. I think we'll probably best that this year, or at least get relatively close to that. So I'm expecting a pretty consistent delivery path that we saw last year on canola. I've been hearing that yields are a little bit better than expected, and that there is a need for some home for some canola. What is a little bit concerning here, though, is that exports have been pretty dismal. A little bit better than last year, but still below average. Exports into week 6 were, as a cumulative, were only 465,000 tons. The average is about 742,000 at this point in the year. So similar to last year, we are underperforming on exports. That is already worked into our S&D. We have been talking about, crush kind of stealing from exports, particularly when you have lower supplies. Exports is the part of the demand that suffers or gets cut as the crush plants try to gobble up as much as possible. And that's what we're going to talk about right next here. Is the crush is performing well. We've got 1.2 million tons already crushed as per the COPA data that is released weekly. That is quite a bit ahead of average. If we're looking at capacity utilization, I mean, the chart looks very similar, but last week capacity utilization was 92.5%. I would call like absolute, pedal to the floor at about 95%. You're never going to see a 100% capacity utilization rating. 95% would be considered very high, or basically running at full throttle. So 92.5% is very high. The utilization rate for the whole season thus far is 89%, which is also very high from a cumulative standpoint. I think we may have weeks in this year where we do reach that 95%, which is, again, essentially running crush rate at full. The margins are good on crush. In Canada at this point, there is very little disincentive to crush. The only thing that would affect, I think, the lowering of crush tons or capacity utilization would actually be availability of seed from the farm. I don't think that's a problem right now. Heard some crushers are actually full for the month of September, so they're not even taking off combine grain or canola anymore. That might not be the case for all the crushers, but I think that there is some good coverage, as there was a lot of business booked up when margins were good. Margins fell off, and now they're rising again. So there might be new business being booked for into January and forward. But I would say that would be the limiting factor right now, is if farmers are reluctant to sell or even deliver because of weather. That might see some ebbs and flows in capacity utilization. But I think the crush market will gobble up as much as they possibly can. Looking at futures charts for canola here now. I'm going to turn on my trusty red pen here just in case. We've seen, some significant declines and some bearish signals. The 20-day crossing over the The 50-day here is a bit of a bearish signal. This is the 200-day down here, which it broke through a couple of weeks ago. Just a couple of days ago, it broke through the 100-day moving average, which was still actually on an upward trend line. We've now reached the 50% Fibonacci retracement level. I don't look at 50% Fibonacci as a solid pivot point. 61.8 is probably a more reliable pivot point. That would actually bring canola down to about 705 or so. I think that's possible. And I actually think it's probable in this downturn that we see something close to 700 before we see a rally. This is normally the time we see seasonal weakness in canola because of delivery pressure and because the industry is generally covered into its fall needs. You wouldn't see the industry go short, want to go too terribly short, particularly in a year where there were early signs of crop stress. So I think that the positioning is probably pretty good. There's not a lot of short covering to happen, and there's delivery pressure happening in the marketplace right now. And so I think that there's going to be a kind of a magnet down to the 61.8 level. As you can see, that kind of falls into this consolidation area here. So anywhere in there, I think would be open game for potential pivot point or a potential bottom in this November canola. These charts look very similar as far as if you extrapolate out into the January or the March. The patterns are very similar. It's just that these numbers change. So just watch. If you're looking at March charts or January charts, look for this zone of consolidation that happened in June. I think that's our target area, regardless of what month we're looking at. Here is just some examples of some protection that you can use both on the put side and the call side. So I'm gonna talk about a put first. This a put style contract. These are available OTC at a number of different elevators, including Cargill, Viterra, Bunge, which was available at Bunge even before the merger. Here's a put style example. You're paying $30 for protection at $745. So if the market does go down into that $700 range, you're already going to be in the money on this option. And if it does continue to move lower after that, if our thesis is wrong about the pivot, you've protected yourself well already, and you'd be well in the money at that point if the market is going to continue to move lower. On the call side, it's actually a little bit cheaper. Same strike, 745. We're looking at about $25. So I think the market is weighing itself a little bit more heavily towards the risk to the downside. What you would use a call type strategy for, or something, it would be if you wanted to deliver, receive cash, move for bin space reasons, but stay in the market. This is priced off the January futures. That would give you exposure into December 15th. So if we are going to see a seasonal bounce, I do believe it'll likely show itself before December 15th, and would give you an opportunity to get back some of what has been lost if the market decides to turn around. I know nobody likes to be forced to sell at this time of the year, and hopefully nobody is being forced to sell at this time of the year. But sometimes it's nice just to move product, to get cash, and to stay in the market. And this would be a strategy that you would utilize to do that with. I like it a lot. The cost of these strategies has come down from a relative standpoint. The implied volatility right now on a call at the money on the January is about 17 or 18%. That is down significantly. It used to be 25, 28%. So for all intents and purposes, puts and calls are on sale right now in the canola market because we are off the highs so much. Here is just some related markets when it comes down to canola, but also I know that there are some of our clients who have soybeans. I think soybeans are also trying to find a seasonal bottom. 1280 would be an area for a potential pivot point here. If it breaks down below that, that would be a bearish sign. So this point right here at 1280, I think will be very important to watch. It has broken through a number of different moving averages and all that kind of stuff already. But this August pullback and subsequent rally because of weather, and now this pullback, if it starts to break below that August low, I would consider that a risk. But at this point, I think there's a potential pivot point here at 1280. We're not that far from there, though. We're just above $13. I think $13 is a bit of a psychological level, so we may see some a bit of consolidation here near this 100-day moving average, which is right around the $13 mark. But I do believe it has the ability to punch down to 1280 before bottoming out. And again, if it moves below 1280, I think that would be a further warning sign. Again, I think soybeans is probably one of the drivers for canola as well. I don't think canola is acting on its own. I think all of the oil seeds are correlated. And as we kind of move through some of these other charts, here's bean oil. Again, we're seeing a bit of a pullback in values on bean oil. If it gets down to this support around 57.50, that could be a potential pivot point. As you can see, we've got a bunch of moving averages as well, converging just south of this area. So if we do start to break down below this area and break down below these moving average lines, that might give us a signal that there's further weakness ahead in the vegetable oil complex. That would be a warning sign for canola as well. All those things might happen concurrently, right? You might see soybean oil fall below those levels. You might see canola fall below 700 and beans take a ride as well. Not saying that that's going to happen, but it's possible that all of those kind of signals happen at the same time, and that could work on the other side too. The bottoming or the pivot points could all kind of happen at the same time at all of these support levels as well. Here's palm oil, a bit of a consolidation mode here as well. Palm oil has seen a lot of losses recently and is being priced nicely into the Chinese markets now. I think palm oil is stealing some of the business from bean oil and from canola oil. I'll show you a chart of that in a second, just to kind of illustrate what I mean. But just kind of getting through all of the related markets. The one that is interesting today is that we saw some gains in Euronext rapeseed yesterday while everything else was moving lower, and we're continuing to see gains in Euronext rapeseed today. So, the rapeseed market looks like it might be bottoming a little bit. The harvest in Europe is ahead of ours, so the bottoming action might be just happening a little bit earlier. I look at this Euronext rapeseed market as a bit of a positive sign, although in order to get bullish this commodity really heavily, I want to see it post a new high above 480 euro. This is the November contract as well. Okay, kind of going back to vegetable oil values here. Canola oil, as you can see, there's some big spreads here between canola and soybean oil, and palm oil is kind of trading right now, landed in China near recent lows, multi-year lows here. So palm oil is pricing itself into the export market or the import market of China. Canola is pricing itself out. And so we see that evidenced in our lower exports as we start the year off. Soybean oil is trying to get itself back to pricing itself in. It's actually, moved considerably lower in China over the last little while. I think that there's probably going to be more demand for bean oil and palm oil into China in the next little while. Canola oil, I think, will lose out on some business. All right, kind of moving into wheat here, just to also show what harvest pressure looks like in wheat. We did see a big surge in prices or in deliveries in week 5. I think that the pullback in week 6 is a little bit concerning. It might start showing, normally this 5, 6, and 7th week of the crop year are the heaviest delivery, and we saw a pullback in week 6. Maybe that is just a reporting error. The licensed elevators sometimes delay reporting just because they're busy at this time of year as well. So we might see a big spike in one of the other weeks that kind of make up for this week. So that might be a bit of an anomaly. But we are kind of seeing if that's the case, if I'm right about that, and there's just some paperwork errors, that's why this shows a decline. We're running close to last year, which is well above average. In fact, I think we're running right at average for, we're running definitely right at average for weekly exports. We've exported about 2 million tons or just under, I think it's like 1.95 or something like that million tons we've exported. I think the average is about 2.05. So we're running very close to averages on our exports. We do tend to see exports pick up, into week 8, week 8 to, call it 18 or so. The next 10 weeks or so is usually really good for weekly wheat exports. So that's kind of what we'll be looking for to gauge if our if our thesis is right about heavier wheat exports. I think the wheat exports could continue to be strong this year like they were last year, because all that, right, as we mentioned, a lot of canola is being pushed into the crush market. Crush market is hungry for it. Export market is not hungry for it. There's lower small crops as well. So, lower pea crops, smaller lentil crops. The buyers and the elevators need to move something. Wheat is an easy one to move, and we don't have a lot of grading issues right now. Maybe some small falling number issues in certain areas, but I think overall the wheat crop is going to be easy to move, and as a result, I think we're going to move more than average of it throughout the year. Also, looking at futures, I'm just going to pull Minneapolis here. All of these wheat markets kind of look similar as far as the pattern goes. We've been talking about, wheat seasonal bottom here. I think that we may be seeing that now. It's always a bit risky to try to call bottoms, but the market is trying to move itself above the 20-day moving average, and it's tested support down just below 760 twice on Minneapolis December. So we may be starting to see the bottom. The thing with wheat bottoms, I find, and this is just kind of gray hair experience talking, is that wheat bottoms kind of take longer than some of the other commodities. So with, say, soybeans or corn, we tend to see V bottoms where we see stark reductions in price and then a surge back in values. With wheat, we tend to see declines in price. It flattens out or bottoms for a long period of time and then starts to rise out of the weakness. So it may take longer than what we want, but I like what this chart is showing us. It's encouraging that that we have seen some consolidation here and a double test of support. Harvest pressure is pretty much now over. The only thing left kind of affecting this market now is the Russian supply being pushed onto the market at cheaper values. One thing I did want to talk about, particularly with wheat and with wheat basis, is that the Canadian dollar has an impact on it. The Canadian dollar has been doing some interesting things recently. As you can see here in this chart, it's been rising through the month of September, from the low 70 or the high 72s now up towards 75. Now, crude oil has taken a massive run in this market. And so if we start to see crude oil come off, I think the Canadian dollar could get weaker. However, today is an FOMC, or a Federal Open Market Committee Fed meeting. The U.S. is going to announce a stay on interest rates, and I think the market is expecting a relatively hawkish tone to the comments. And what I mean by that is that there's one more rate hike that could possibly come this calendar year, and there's also been some talk of them taking rate cuts out of the plan for not all rate cuts, but just lowering the amount of rate cuts planned for 2024 as well. So overall, the market has been building in a hawkish tone to the U.S. Monetary policy, and that kind of means that we have seen this kind of rise. So it's kind of odd that the U.S. dollar rises and the Canadian dollar rises at the same time. So if the U.S. dollar does peel off, we could actually see further gains in the Canadian dollar, which would actually erode, wheat basis, for example. So there is possibly some risk on the Canadian dollar on wheat basis in Canadianized values. Now, the flip side to that is, yesterday or in one of these recent morning commentaries, I talked about how crude oil looked overbought. And if crude oil is going to take, it's had a big run up because of the Saudi production cut issue. If crude oil is going to take a breather, the Canadian dollar could come back down as well. And that would actually do the opposite. It may actually strengthen your weak basis if that happens. Again, all other things being equal. So there's a lot of moving parts to this and a lot of balls in the air right now. So it's very hard to predict. But I just wanted to make you aware of all of those risks and opportunities. All right, to round out the day today, I wanted to talk a little bit about oats. Now, oat futures have lost about 10% of their value just in the last 2 or 3 days. Big declines in oats. I haven't heard that much in response to cash prices. I would say that our cash position right now is we are undersold what I would like to be. I want to get more coverage on in oats. And if it does look like the cash is going to respond to these futures declines, I might want to take some risk off the table as well on there, or reward the rally would be a better way to say it. So you may see an oat recommendation across your desks in the next little while, or across your phones in the next little while. Just wanted to take advantage of the recent rally and make sure that we aren't giving up some of those opportunities. All right, that is all we had for you today.